So what does it mean to take an opposite position? Just to say, you see this horizontal line, it's pointed more or less to 38. I couldn't point it exactly. Why is that? Because I have a short put 38 sold on this stock. Why is that? Because my expectation is that the price within today and December the 20th will not be below $38. What would I do should it be below is something we will see later when we will speak of naked put selling and how to manage it when it goes wrong. So far, let's focus on short selling of calls. Aside the fact that I strongly disadvise you to short sell naked calls on American stocks, because you cannot forecast what could happen, and in the case of American stocks, nobody can tell that the price of a stock will not increase 50%, 100%, 200% in a few days, a few weeks, or a few months. So it's very risky to open naked call positions on American stocks. You can do it quite safely on stock indexes, but not on stocks. What could be, anyway, ignoring any other consideration, any other reasoning, what could be the advantage of short selling a call 43, just to say, not a 42, because if the price breaks out this maximum, it will very likely cross $42. So maybe it will cross $42, but not 43, not 44, not 45, of course. The farther the strike, the lower the chances to cross it. So let's just, to make an example, assume that we think that the price could perhaps reach and cross $42, but maybe not 43. So what about short selling the call 43 maturity December the 20th? We would collect $37. And what could be the scenarios at maturity? The scenarios at maturity could be that if the price goes to $50, let's say I made a huge mistake, I short sold a call $43, I collected 37 cents, so my break even is 43.37. How much am I going to lose if at maturity the stock is 50? 50 minus 43.37. Spot price minus the break even point, so it's $7.63 per share, so it's $763. And some could say, hey buddy, what is the logic of short selling something, collecting only $37 and taking the risk to lose $763 if you're wrong? It's all a matter of probabilities, as I already told you. So you have to find a way to decide if probabilities are more on your side or if they are more against you. So let's assume that the 43 calls has a very low probability to get in the money at maturity. What do I have to take care of? Of just one scenario, that the price increases and crosses 43.37. If the stock increases but not so much, if the stock increases just a bit, if the stock remains stable, if the stock goes down a bit, if the stock goes down a bit more, if the stock goes down a lot, if the stock drops significantly, in any of these situations, I will keep the money collected. So once again, it's all just a matter of probabilities on each side of the wall. You have to try and, for expectations, most of all about the probabilities of events. And when you have probabilities on your side, you can short sell options because on a statistical basis, they provide a higher probability of gaining money. And that's it. Short selling on stock options is strongly disadvised, but short selling of put options is much a better strategy. Under some conditions, of course, you have to pick the right stocks. You have to pick a stock that Basically, should you be in the money at maturity, you would not worry about getting assigned the underlying. What does this mean? If you short sell a put, let's say a put 37, for instance, you are giving someone else the right to sell to you 100 shares of AMD for $37 each at or within December the 20th, 2019. So what your risk is? Your risk is to be assigned to have the obligation to purchase 100 shares of AMD for $37 each between today and December the 20th. But if you think that AMD is a good stock and it would be not so bad to have the obligation to purchase it for 37 within the next 15 days, while in this moment it's quoting 39.69, so it means to buy at a discounted price, then it could be a reasonable strategy to apply. So what would happen should the price of the underlying of the stock AMD be lower than 37 at maturity? You would have the obligation to purchase 100 shares of AMD, and you would keep the money collected from the short selling of the put. How much could that be? Let's go check. The put 37 quotes 0.44, 0.46. So if you would be sure to get executed immediately, you would hit the best buyer and short sell that put for 0.44 per share. So what would this mean? You would purchase 100 shares for $37 each, but you collected 0.44 that you do not have to restitute to the buyer. So basically your average price per share is not 37, but it's 37 minus the premium collected, 0.44. So it's 36.56. That is your real price. The price you really purchase the stock for. Then what? Then you have several choices you could take. And here we get into the combinations of options and shares. One very smart strategy, very common, very popular, used by many traders around the world is the so-called covered call writing. It means to sell a call covered by the stock. So you start with a naked put, you get executed at maturity, the price falls down below 37, you get assigned, you have the obligation to purchase 100 stocks or 100 shares of you have the obligation to purchase 100 shares of the stock Advanced Micro Devices for $37 each. You have $44 in your pocket as the premium collected from the short selling of the put. Then what? Then you go to the chain of the options expiring, let's say, on January, February, March. It depends on how much the stock fell below 37. Because if at maturity it's 36, then you could think of selling a call 37 maturity January, perhaps. If the stock is 34, maybe in order to be able to sell the call 37 and collecting at least some money, you would have to look at the February maturity, maybe the March or even the June, who knows? It depends on the specific situations. But for sure, you could find most of the time, of course, if the stock drops to 28, it's very hard to sell call 37. So pay attention. This is not a strategy that works all the time. You have to know how to manage all the possible situations that may arise. Okay, I'm just making some examples. So once again, you start short selling a put 37, then you are wrong. The price drops, the price goes to 35, just to say. Your average, your the real price of charge of the shares is 36.56, 37 minus the premium collected, but let's look to 37. You go to the January chain, the February chain, the March chain, it depends on what you find, and look for a good call 37 to be short sold. Why do you do that? Because in the moment you have the stock and you short sell the call 37, you are selling to someone else the right to buy from you the stock for $37 per share. And that's exactly the price you purchased it for at the maturity of December. So let's assume that for the call 37 you collect 20 cents, just to say, okay? So you are transferring to someone else the right to purchase from you your 100 AMD shares for $37 each, the same price you paid them for, and you're gaining 20 cents in order to give someone else the right to do this. So what could happen at maturity? The price bounces, the price of the stock bounces, gets again above 37, you are assigned, and this time you sell your shares because someone else has the right to buy from you, so you have the obligation to sell. So you sell your 100 shares for $37 each, and what you keep the 20 cents collected from the short selling of the call, plus the 44 cents collected from the short selling of the put in the very beginning. So in the end, you collected 64 cents on shares that remain in your portfolio for just a month, and that's it. So this is how you can combine naked options and then the shares you get assigned off as a result of the exercising on the option short sold the previous month, and then you combine your stock with some other options for the next month. And you start over and you go all the way on doing this: short selling puts, short selling calls, short selling puts, short selling calls. Of course, the risk of this behavior would be if the stock drops significantly, and then you need to know what to do, how to manage these situations, and this is not a purpose of this course, so I will stop here.